Fannie Mae has issued a warning in their recent press release that the banking system instability could trigger a recession. So in this video, we're going to unpack the details and discuss what it means for the housing market. If you're a homeowner, buyer, or seller, you will not want to miss this. Let's get right to it. Fannie Mae's Economic and Strategic Research Group, ESR, they just revised the first quarter 2023 GDP forecast upwards. This was a surprise to the upside because we saw mortgage rates fall and we saw homebuyer activity pick up. This number was actually finalized prior to the financial turmoil that we're starting to see unfold here in the banking system. And now Fannie Mae is actually projecting a modest recession going into the end of 2023. Generally speaking, a recession is going to be defined as 2 negative quarters of gross domestic product, or GDP, which according to Fannie Mae, we are starting right now in Q2. So we would have a quarter of negative growth. We'd have a second quarter, which would be Q3 negative growth. And then by the time we get to the end of the year, or Q4, we're going to be looking backwards at this data saying, yes, we are officially here in a recession. Now, if we look at their forecast, as we go into 2024, we see positive growth again. So this would in fact be a modest recession if it unfolds exactly how they think it will. While uncertainty has risen following turbulence in the banking sector, the ESR group noted in its last monthly commentary that bank failures often foreshadow economic downturns. Further, the ESR group believes that recent events may act as a catalyst that tips an already precarious economy into recession, primarily via the combination of tighter lending standards among small and mid-sized regional banks and weakened business and consumer confidence. However, it is important to note that even though they are sounding the alarm bells here, they do not anticipate a repeat of the 2008 financial crisis. Instead, they believe that the savings and loan crisis from the 80s to be a better analog, specifically regarding the significant interest rate rises that set in motion the banking system stress and the resultant macroeconomic effects that contributed to a modest recession in 1991. The savings and loan crisis of the 1980s and the 1990s was actually a failure of nearly 1/3 of all savings and loan associations in the United States. Now, this all started to unfold in the late 70s and early 80s when the Federal Reserve raised the federal funds rate, this red line here, to break the back of inflation, this magenta line. And at the time, savings and loans had issued long-term loans at fixed interest rates that were lower than the newly mandated interest rates at which they could borrow. When interest rates at which they could borrow increased, the savings and loans could not attract adequate capital from deposits and savings accounts. And attempts to attract more deposits by offering higher interest rates led to liabilities that could not be covered by the lower interest rates at which they had loaned. And the end result was about 1/3 of all of these associations became insolvent, which is very similar to what we are seeing unfold with the small and regional banks today and what had happened with Silicon Valley Bank and Signature Bank. The ESR group also highlighted downside risk to its interest rate forecast as banking-related stress may slow the economy and relieve inflationary pressure, in effect, relieving the Federal Reserve of potentially having to raise rates as high as previously expected. In other words, if there are less financial institutions that are willing to lend and there is ongoing uncertainty in the economy, that may actually help the Fed with their mandate to bring inflation down. The article goes on to say that while home sales experienced a large bump in February following a pullback in mortgage rates, recent mortgage application data suggests that last month's level of home sales will be temporary. They also note that the ongoing banking instability may affect the availability of jumbo mortgage and residential construction loans. A large amount of these types of mortgage products were actually offered by small and regional banks. So if they are tightening their lending standards, there are going to be less and less programs and products that are available. And the tighter lending standards aren't necessarily just going to be confined in the small and regional banks. This is going to reverberate out through larger financial institutions and mortgage brokers as well. The ESR group's expectations are that home sales are going to remain subdued due to ongoing affordability constraints, and affordability still remains at the forefront for most home buyers. Because even though mortgage rates have gone down, home prices have not come down proportionately, and in many markets, those prices are still significantly detached from the local wages. They also cite that the lock-in effect is going to continue to create a strong financial disincentive for homeowners to move. And of course, they're referring to home sellers here who have locked into really low fixed rate debt, and they are not wanting to trade up into that bigger house or go into the luxury market because they know their interest rate will likely be twice as high as what they currently have today. And speaking of mortgage rates, the average 30-year fix for a conventional mortgage is sitting at about 6.5%. So it's up just a hair from last week, so the volatility continues. And then as we wrap things up, I wanted to let you know what Doug Duncan, Senior VP and Chief Economist of Fannie Mae, said. He said that while housing at large has responded to the Fed's monetary tightening in a relatively predictable fashion, the rapid uptick in home sales in response to modest rate declines earlier this year corroborates our long-lasting expectation that the housing sector will help moderate any future recession due to the significant pent-up demand. In other words, he believes that if we go into a recession, it will be short because the housing market will help pull us out of it because we have a significant amount of homebuyer demand sitting on the sidelines right now. And one thing that I do want to make sure that everybody understands is that there are different segments to this housing market. For instance, the first-time homebuyer or starter home market is still relatively strong. Despite affordability really impacting the homebuyer, there is still a large enough demand that those homes are moving in relatively quick fashion. In fact, the inventory levels for the quote-unquote starter home are actually going down. So supply remains constrained while there is still a pent-up demand. Conversely, you have the move-up market and then you have the luxury market, and those are the homes that are sitting longer in the market. They're taking price declines. They're not getting multiple offers. Point being is that not every market is unique and different. So make sure that you dig into the details for your specific market and understand those nuances. All right, that is going to wrap it up for today's video. If you enjoyed the content and found it useful, please consider hitting that like button, subscribing for more weekly housing market data, and we'll see you on the next video. Thank you so much. Take care.